Alibaba announced earnings this morning and revenue, and they beat the market. They beat it big. At one point, they were up 7 or 8%. Now they pulled back a little bit. So they were expected to earn $1.57 per share. They earned $1.75. They're expected to have revenues of just a shade over $30 billion, 30.05, and they reported $30.69 billion. Now, their sales were still down from last year, but they had big jump in cloud computing, and there were slowdowns in other aspects. And we are seeing slowdown in other e-commerce businesses in terms of their revenue for the previous year. So what does this mean? Well, for me, as a value investor, it doesn't mean much. If they had missed, I would, unless there was some major point that they made that made me go, oh my God, my thesis is wrong, I would still stick with the plan here. Alibaba is a growing company. It is in the world's largest economy and the fastest growing middle class in the world. You got to remember, guys, China does not make a lot of money per person. We are almost, I think it's like 10 times bigger per capita than China. They have so much more growth potential. So what does that mean about Baba? Well, as the largest company in the fastest growing, basically major economy with the fastest growing middle class, how is it not going to win a long period of time? Well, as an investor, does that mean you go out and buy it? Well, not necessarily. Just because something has a lot of growth potential doesn't mean it's going to do well as an investment. Look at the dot-com bubble. The internet was a fraction of today, back then, is what it is today. Yet how many companies still went under? Just because there's a growing potential market doesn't mean every investment in there has good potential. If you pay a reasonable price for that investment, that's how you make good money. So if you're new to this channel and you're hearing this and going, that kind of makes sense, I'm Paul. I'm a value investor. My goal is to not make decisions based on quarter-to-quarter results. Now, I report these just because I know everybody likes hearing that, but I also look at these results and say, is this still in line with my thesis? Going forward, am I owning a company for a long period of time that I like owning at a reasonable price? And with Baba, what we're going to do is we're going to look at it using our 8-pillar process and our software, and then we're going to put in our stock analyzer tool to determine what to pay for Baba today based on our projections for the future. I'm also, even though I don't necessarily put a lot of weight in it, going to show you analyst expectations for their revenue and profit. So let's pull that up first before we go any further. These are the analyst expectations for revenue and profit for the next few years. This is earnings per share. They're expected to do $7.36 this year, and by 2028 to do on $13. So it's still growing. Is this major growth? Not necessarily. And again, these are analyst expectations. The further and further you go out, the harder it is to make accurate numbers. Let's look at the revenue expectations for the next several years. It goes out a little bit further here. So they're expected to do $136 billion in revenue this year, which is an increase of about 8%. And over the next 10 years, look at this though, $320 billion in revenue. That's big growth. But again, I want to remind you that just because a company has a lot of growth potential doesn't mean you buy it. You can overpay for growth. In fact, most times that's what people do. They overpay for growth and they get scared when the growth doesn't hit and the stock starts tumbling when it might become the right value play at that time. So let's pull up our software and start our process. So if you have our software, if you're part of our community, please follow along because it's a great way to learn how to do everything. So I'm going to hit my disclaimer, go to stock search, type in Baba. And guys, just an example of how things can, look at this. It was at $104, $105 earlier. Now it's at $97 today. Just an hour and a half ago, pre-market, it was $103, $104. Yesterday, eBay reported. eBay crushed it. And guess what? They were up 8% after hours. Now let's look at eBay. eBay is now down $2.79. They were at over $50 yesterday at one point. They're now down $2.79. Actually, it was more than, they're up over $450. So guys, these things are so fluid. They change all the time. Don't get caught up too much in the hype of every single individual stock just because they report good earnings. So let's start with our 8-pillar process. Pillar number 1, we want the 5-year PE ratio to be less than 22.5. Right here on our main page, beautiful, 17.3, check mark there. Pillar number 2, we want the 5-year return on invested capital greater than 9%. Right here, 5-year return on invested capital, 11.1%, check mark there. So far we have 2 check marks. No dividend paid, but we have a few other things on this page. Growing free cash flow. The last 5 years, they've averaged about 20 billion. Last year, they got 21 billion. And as you know, the stock is down a lot. So this is where you need to pay attention to the company to see if it's worth it. Now, pillar number 3, very simple. I want revenue growth over the next 5 years. So I go to the income statement and I scroll down a little bit. 5 years ago, they did 37 billion. Last 12 months, they did 126 billion. Check mark there. Great work. Pillar number 4, we want net income growth over the last 5 years. So we scroll down just a smidge, 9.5 billion, and it actually fell in the last 12 months to $8 billion. Now, I believe there was some sort of write-off, maybe up here. Yeah, right here. $2.1 billion and a $3.7 billion charge. So there are some extras in there that kind of sway it. But again, that's your goal as an investor. Look at the long run. They might have fluke years here and there on the up and the down. You're supposed to go through with it. Pillar number 5. Now, this one is one that not many people pay attention to, and I call it the silent killer of investing because of that. We want to make sure we're not being diluted as owners. When a company issues more shares, they're diluting the existing owners and giving them less and less of the company. We want to make sure the shares are staying the same or going down if the company is very undervalued. So in this situation, we go back to 2.54 billion shares at the end of year 6, and now we have 2.68. So they're also increasing their shares, not by a lot, but it's still increasing their shares. Now, pillar number 6 is about debt, and debt works for a company the same way it works for you. The more debt a company has, if times will get tough and recession hits, they're less likely to be as successful. As interest rates go up, it's going to affect their bottom line a lot more. So the question you have to ask is, what's a reasonable amount of debt? So I've created this metric. I go to our 5-year average free cash flow, and I multiply it by 5. So basically here, it's $98 billion, give or take. So we want to see if their long-term liabilities are less than $98 billion. So we go to our balance sheet and we scroll all the way to the bottom. Total long-term liabilities, $34 billion. Checkity check right there. They can basically pay off their long-term liabilities in 1.5 years of their free cash flow. Now, pillars 7 and 8, the final 2 pillars have to do with free cash flow. And free cash flow is the lifeblood of a business. You can do it's caps from operations, less your capital expenditures. You can do one of 5 things with free cash flow. You can pay dividends, buy back shares, pay down debt, reinvest back in yourself, or make acquisitions. You can do all 5, none of them, any combination of the sort. So let's go to the cash flow statement. And we added the free cash flow line to our cash flow statement here. Now, the data feed we get hasn't imported all these things from the previous quarter. So let's just go over here to the previous 5 years, 9.7 to $28 billion. Check mark there. So they are growing their free cash flow. And the final metric is we want to take the 5-year average free cash flow and treat it like a PE ratio. So we take the $20 billion, we multiply it by 22.5, we get $450 billion. So what this says is we want the market cap to be under $450 billion. So we go back to the main page here and we look at their market cap. It is $260 billion, check mark there. But again, guys, let's go to the 8 pillars and look at all these metrics. So net income's down, shares outstanding is up. So we have 2 things here that we don't like, but the question is, do we still buy the company? Well, that's what we use a stock analyzer tool for. Now, before we get into that, I want to explain something. There's a lot of talk about Alibaba getting delisted from the US exchanges. This has caused a lot of fear. People are getting upset about it. The stock has plummeted. It's one of the biggest things I heard when the stock was up way higher. I called Merrill Lynch, the people who have my money. I said, guys, this was months ago. What happens if Alibaba gets delisted? They said, well, you get the shares in Hong Kong. I'm like, great, what does that mean? They're like, well, you just get shares of the company in Hong Kong. I said, okay, is it bad for me? Well, the only bad part is what they said to me. That's what they said to me. And you should talk to your broker about what they say to you. They told me, Paul, if you ever want to liquidate, it might just take a little bit longer to get your money out of Hong Kong back into US accounts. That's it. That's it. That's what they told me. I'm regurgitating specifically what they told me. Your broker might say different. But basically, it's a perception issue. And remember, every single day, Mr. Market's going to tell you a price that he wants to buy or sell shares at. And it's your decision whether you buy or sell them. But one thing I want to remind you guys about is, look at the last year of Alibaba. Look at the last 5 years of Alibaba. The stock is selling for levels below its IPO, below where it was 5 years ago. But 5 years ago, the revenue was 1/3 of it where it was. The profit was 1/3 of where it is. Does that make sense? You got to remember, if it's a growing company, and as long as you're okay with having shares in Hong Kong, what is the difference whether the shares are in Hong Kong, Timbuktu, Antarctica, or the US? Yes, it feels much better for it to be in the US because you're used to it, etc. But what's the difference? This is where you have to sit there and use your analysis to say, do you feel comfortable with it? Now, Charlie Munger feels comfortable with it. He has a substantial position in Alibaba. That doesn't mean you should go buy Alibaba just because he has it. It didn't mean that for me. But what it meant for me is I trusted Munger, and Munger trusted the numbers out of Alibaba. The issue we're having is Alibaba has said that they want to make sure that they adhere to all U.S. and foreign financial requests. But they also announced today that they're going to work on getting their main brokerage their company be held in Hong Kong. That is a big thing, but that doesn't mean they're leaving the U.S. But if the U.S. delists them, be ready for that. If you cannot stand that, you should avoid this company completely. So back to what you should pay for Alibaba. So our stock analyzer tool is phenomenal because every investment is the present value of all future cash flow. We don't know the future, so we have to make assumptions on that. You can do a 1 to 20 year analysis. I always pick 10. It's going to give you the data that we have here from our data provider: revenue growth, profit margin, free cash flow margin, current PE, current price of free cash flow. It's going to ask you to make assumptions of the future. I'm going to hit the analyze button and it'll give me spit out some numbers for me. Now, make sure you watch this portion over and over if you don't get it, because I'm going to explain very thoroughly how I'm coming up with these numbers. It is all assumptions I'm making. I have no knowledge of the future, but my goal is to make conservative assumptions and buy companies at prices below those conservative assumptions. So let's start with revenue growth. In the last 5 years, they've done 35.9% per year. Last year, they did 18.9. We don't have data going back 10 years. Now remember, guys, you saw our revenue growth numbers here. 320 billion versus 136 over 10 years. So 320 divided by 136 to the power of 0.1 tells me it's 9% growth rate per year in terms of revenue. Okay, that's what all the brokers are saying. So I'm going to put that on the high side of 9%. Middle, 7, low side, 5. I'm just going based on analyst expectations being overly optimistic. Could they be under optimistic? Absolutely. They could be under representing what it could be. I just like to start somewhere there. Now, 5% is the lowest number I've ever picked for BABA. I've always picked 7% or higher. Now, profit margin. In the last 5 years, they've done 18.7%. They did 6.4% last year, but remember, they had that big write-off those years. So I'm going to focus more at the 18%. I'm going to do 16, 18, and 20%. I'm going to go a little bit lower, a little bit higher. In this situation, I'm going to go higher because they are in the cloud computing business, which has very high margin. And I believe as the Chinese economy gets better and better, their margins will increase. Free cash flow margin. Now look at this free cash flow margin. A lot different than profit margin. So I may be underdoing it on the profit level because over long periods of time, free cash flow and net income should be very similar. So I'm going to go with 18, 20, and 22%. PE. Now, the current PE is 32, but remember, it's with those big write-offs they had previous year. So I'm going to go with the long-term average of 14, 16, and 18 for both PE and price of free cash flow. Now, remember, over long periods of time, historically, the average PE is about 15. As a company gets bigger and bigger and bigger, it can't justify a higher PE because it's harder to grow. But I do believe that with the moat and how big it is, I can still sit there and pay a reasonable price for BABA, which would be about 15 times earnings. So that's why I'm putting in 14, 16, and 18. Now, if you want to be conservative, you put in 13, 15. Actually, let's be more conservative. Let's put in 13, 15, 17. And finally, for my desired return, I'm going to put in 12.5%, and here's why. I'm comfortable with the shares going to Hong Kong. But if you perceive a lot of risk in there, put a higher amount. That gives you more margin of safety. Because remember, guys, you can invest in a long-term ETF and make 9 or 10%. So in order to get this company and buy an individual company, give yourself some margin of safety. So I'm hit the analyze button. The stock is currently about $97 a share. It's going to give me 6 numbers: a low, middle, and high for earnings, and a low, middle, and high for discounted cash flow. If they're all green, does that mean you immediately go buy it? Not necessarily. Go do more homework. Make sure these assumptions are correct. Join our community. Less than a cup of coffee per day. Even if it's just for one stock, it's going to cost you $30. Go in there, talk for a month with our community members. You're going to love it. There are thousands of people in here. You can use all these tools you see here to analyze and understand the company, including access to their 10K, etc. Go understand the company. If it's all red, does that mean you avoid it? Well, no, not necessarily. If it's pretty close to 97, but all red, maybe you keep it on your watch list. Right here, you can add to your watch list and keep track of it. So I'm going to show you the numbers, make a quick thing, analyze button, let's go. Guys, all green. Low side, 100 to 115, high side, 200 to 215, middle is 150. This is where we stand, guys. I appreciate your time. Do your own research, and remember to subscribe to our channel if you like what you saw. Thank you.